Now, the role of the accountant is to record business transactions, summarize business transactions, and present those results to end users, people outside the business as well as management. And they do that in the form of financial statements. That's what this module is all about today. Communicating with users. Companies actually prepare 4 financial statements: a balance sheet, an income statement, a retained earnings statement, and a statement of cash flows. We begin with the income statement. You always begin with the income statement. We want to know how well this business has done over the last, say, year,
how much income you have,
or so on. And that's exactly what the income statement tells us. It is the income statement for this company's year of operation.
It's also
For the month ended October 31st. Now, the income statement is called a time period statement. And in the heading, you see the time period. That is a month ending October 31st, which means the following is a summary of revenue that has been earned from October 1st to October 31st, and that is $10,600, and expenses that have been incurred in order to earn that revenue from October 1st to October 31st, in this case 2012. Now the expenses are $7,740. You see that on the outside column. In accounting, when we want to present data and we're going to add up a lot of data, we move inside to a new column. So in the middle column, you see the list of expenses: sales expense, supplies expense, rent expense, insurance expense, interest expense, and depreciation expense. Now we draw a line, and the total expenses are carried to the outside column. And on the outside column, we only have 2 things: revenue, which is the amount of sales or services this company has provided, and expenses. Expenses is what has been consumed by the business in order to earn the revenue. They had consumed rent to earn that revenue. They consumed supplies, interest expense, and so on. So on the outside, you see we have revenue, $10,006, and we have total expenses, $7,740. So the difference between revenue, and we subtract the expenses, and we have what's called net income, $2,860. Now we're finished. And in accounting, you show that you're finished by doing a double underline. So you see that the double underline. So this company has made, in the month of October, a net profit or net income of $2,860. Now, this company is owned by shareholders. So that money belongs to the shareholders. The retained earnings statement for Sierra. Notice it's the same time period, October 1st to October 31st. The month ended October 31st. Now, they started off October with no revenue or no earnings because the company only started October 1st. So the shareholders have not earned anything. Now we add the earnings achieved during the month of October, 2,860. So in total, the earnings that belong to the shareholder, they're called retained earnings, 2,860. They're called retained earnings because the company has those earnings in their records, 2,860. They belong to the shareholders, but the money has not been given to the shareholders. The company can decide to give it all in the form of a dividend when we pay a shareholder. That is called a dividend, or just a portion of it. In this case, just a portion. They're going to pay 500 back to the shareholders, and the company is going to keep or retain the rest, which is 2,360. Now that 2,360 belongs to the corporation, but the corporation is owned by the shareholders. So in effect, it is part of the shareholders. So you see, the statement shows the change in time from October 1st to October 31st. Now we look at the balance sheet. The balance sheet consists of three parts: assets, liabilities, and shareholders' equity. You see those three categories on the balance sheet. Now, to begin with, this is the balance sheet, and it doesn't have a time period. It just says, as at October 31st. This is like a snapshot of what the company has in assets, who the company owes money to, which is liabilities, and how much is the investment or the retainment or ownership of the shareholders. How much is owned by the shareholders. So if you think of the income statement as a moving picture, started from October 1st to October 31st, you think of the balance sheet as a photograph at the end of October 31st. At the close of business, this is what the company had in assets. It had cash, $15,200. It had accounts receivable, $200. Supplies, $1,000. Prepaid insurance, $550. And equipment net, $4,960. Now, many of these accounts you will learn later in this course, but right now those are all asset accounts. And when we add them up, we have a total, $21,910. We double underline it. That's the end of the assets. Now, the liabilities represent businesses or people that the company owes money to. And therefore, they will have to be paid out of the assets. So in a sense, the people who are owed money, they are called creditors. They have a claim on those assets. Who has a claim? Well, notes payable. People who own a note from the company, $5,000. Accounts payable. Now, those would be businesses that have supplied the company with either services or inventory or products. Salaries payable, we owe the employees. Unearned service revenue, We'll explain that later. And interest payable. So in total, notice we totaled them up and we carried it to the outside. The total liabilities, $9,550. So the $21,000 does not all belong to the shareholders because we owe people outside the business, $9,550. So what is left belongs to the shareholders. So the next is the shareholders' equity. Now, common stock represents how much the shareholders invested in this business. They purchased stock or shares. And they paid $10,000 for those shares, and therefore the business has the $10,000. But it's common stock shareholder. It belongs to the shareholders. And then we add the retained earnings. Remember the retained earnings statement, which was $2,360. That belongs to the shareholders. So we added $2,360, and we total the shareholders' equity, $12,300. And we add the liabilities, and we add the shareholders' equity, and we get a total $21,910. We balance assets equal liabilities plus shareholders' equity. And I have assets of $21,910. I have liabilities and shareholders' equity, $21,910. And there we have what is called the balance sheet equation. Assets equal liabilities and shareholders' equity. Now we always list assets first, then liabilities and shareholders' equity. Now, the final statement is a very important statement, which we'll take more depth later in this course, and that is the cash flow statement. Now, this is a cash flow statement, time period from October 1st to October 31st. Now, what we're explaining is the cash, the total cash that they have, $15,200. Well, why do we have that? Well, you see, the cash flows come from three separate areas. There's cash flows from operations, that's first. There's cash flows from investing, that is investing in plant and equipment. And there's cash flows from financing. That is, if I sell shares, I get cash coming in. If I borrow money, I get cash coming in. If I pay back the money I borrowed, there's cash going out. So we're going to just track cash coming in, cash coming and going out. So you see cash flow from operations is $5,700. Now, cash flow from investing is a negative $5,000 because I purchased office equipment. And then cash flow from financing, well, I had the $10,000 that came in from the shareholders. I issued notes payable of $5,000. You see that as a liability over there. And I have paid them a dividend of $500. So when it's cash out, we bracket it. It's negative. We totaled that, it's $14,500. We had no cash at the beginning of the month. We now have $15,200. How did I get that $15,200? $5,700 minus $5,000 plus $14,500. And we will discuss the statement of cash flows in more detail towards the end of this course. To begin this course, we focus on the income statement, the retained earnings, and the balance sheet. And all of these are ways in